Good morning, and welcome to today's webcast, Tax Planning Strategies for Individuals. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Michelle VanDellen, Partner, Charity Falls, Tax Managing Director, and Dominic Cellitti, Senior Financial Advisor. And with that, I will pass it over to Dominic to get us started.
Good morning, everyone. Thanks for joining us. I'm Dominic Cellitti, Senior Financial Advisor, and I'm joined by my colleagues, Michelle and Charity, here with you today. So just a quick agenda for us all. We're going to talk through a few items today. To start out with the estate planning outlook, the Treasury Department updates, IRS updates, and then some considerations for your wealth, being market trends and year-end considerations on the personal front. If we have some time at the end, we're happy to address any Q&A. If we don't, we will always follow up with you after. So with that, I will hand it over to my colleagues.
Thanks, Dominic. So I'm hoping the right slide is showing, but essentially I titled the slide Sunset New Legislation or Estate Tax Repeal. Prior to the election, kind of thought we knew what might happen with estate taxes, and all of that changed with the election, with the Republicans sweeping, all three branches of government in the election. So, questions you may be asking is, what does the Republican sweep of the U.S. elections mean for gift and estate tax planning? How should I prioritize estate tax planning, and how can I prepare for the unknown? And that's what I want to address today. Republicans tend to favor lower taxes, so it's expected that with control of all three branches of government, that tax policy may be an early priority when the government changes hands. And whether this means that Congress will enact new legislation that would extend existing or other, higher estate tax exemptions, or enact full estate tax repeal is yet to be seen. There's another faction of Republicans, though, that have concerns over the federal debt. And, we hear a lot about deficit spending, which represents sort of a single year overrun in expenses over receipts coming into the federal government. But those deficits without reduced spending or higher revenues accumulate over the years. And that ends up, being what we call our national debt. And the current national debt in the U.S. has surpassed $36 trillion. And just to think about what that means, a trillion is essentially a 1 with 12 zeros behind it. And there's a really fun image of this on the internet, which I enjoy. It's essentially a visual of $100 bills stacked side by side, and they span, up to 6 feet tall, and they span the length and width of 1.5 football fields. And that represents $1 trillion. And then you multiply that by 36, and that's, basically where we are with our national debt. And servicing the interest alone costs the federal government somewhere between $700 billion and $1 trillion, which is more than the government spends on defense. So, there's this balancing between people who are, ideologically, opposed to increasing taxes, or are for tax cuts, and then those that are concerned about this federal debt. So under current law, larger lifetime gift and estate tax exemptions that were allowed under the 2017 tax law are scheduled to expire at the end of 2025. And if there is no legislation, this would just happen automatically. And with a slim Republican majority in the House, this will require the passing of the law again by the reconciliation process, which, and if not, will revert back to 2017 levels. And as we saw with the 2017 Tax Act, Congress was able to pass tax cuts with the required, able to pass tax cuts with the required 60 votes that it needed. So it used the reconciliation process to do that. And to provide some background and really your civics lesson for the day, normal filibuster rules require that 60% in the Senate vote yes to pass legislation. But budget reconciliation is a special exception to this rule that was created in the 1970s to permit the Senate to reconcile budgetary matters with a simple majority vote. So reconciliation bills are limited, though, and they can only address 3 topics, which are spending, revenue, and the federal debt limit, and only those topics. So the Senate can pass 3 of these per year, one affecting each of those topics, spending, revenue, and the federal debt limit, although historically, these are often combined into a single bill. And we've seen reconciliation used, in recent years to pass not only the 2017 Tax Cuts and Jobs Act, but also the COVID stimulus plan, which was referred to as the American Rescue Plan in 2021. And for a bill to become law, legislation must be adopted by both the Senate and the House of Representatives. And then once it's passed by both houses of Congress, it then goes to the White House for signature. And with Republicans controlling both houses of Congress and the White House, it's likely we will see, Congress moving to pass tax law through the reconciliation process. Now, back to estate planning. As a quick recap, an individual can give up to $18,000 per year to any number of people without being required to report that gift, with some exceptions. You can think of this as like a de minimis amount that you can give each year, and it's use it or lose it. It expires at the end of each year, December 31. And that annual exclusion amount is scheduled to increase to $19,000 in January. Any lifetime gifts in excess of that amount must be reported on a federal gift tax return, and that'll begin to use up a portion of that person's lifetime gift and estate tax exemption. Now, remember, the gift and estate tax exemptions are currently unified. That wasn't always the case. But that means that if you have a $13.61 million exemption today, which is the current exemption, you make a gift of $1 million to a child tomorrow, and then you die the following day, your executor or trustee could apply the remaining $12.61 million against the full value of your estate before that 40% estate tax would accrue. And I mentioned that the current exemption is $13.61 million. And that's scheduled to rise under current law if there are no changes to $13.99 million in January, so next month, or nearly $28 million per married couple. Under the current law, the lifetime gift and estate tax exemption will decrease based on Labor Department inflation figures to about $7 million we're estimating on January 1, 2026, without further action of Congress. Again, prior to the election, wealthier families who could afford to transfer assets in excess of $7 million, usually in trust, for children or grandchildren, and maintain their cash flow needs and standard of living, they were feeling a lot of urgency to move assets before the expiration of the Tax Cuts and Jobs Act to lock in those larger exemptions. And that's really because the IRS issued a ruling in 2019 around there saying that after the sunset, transfers in excess of that estate tax exemption that were completed prior to the sunset, that they would be respected and avoid estate taxes going forward. So now that the election has happened, I'm sure some people are less anxious to transfer these large sums in anticipation of legislation that would extend the exemptions. But again, that requires a gamble. Remember those, football fields, nearly 40 football fields of stacked $100 bills. There's this competing interest within the Republican Party. So it's still a bit of a gamble to wait and see or to not take action. Obviously, with this type of uncertainty, we have to look at sort of the totality of the circumstances for each individual family. Estate planning, is important for many different reasons, and not just tax. It can provide, in addition to systematic division of assets at death, it can also provide creditor protection. It can provide privacy protection. It can protect assets for minors and unprepared heirs. It can also provide protection from potential divorcing spouses, and on and on and on. There are just many, many other reasons to think about this and to take action. And also, estate planning must be sort of custom for each family, and it requires an understanding of their comfort level or with complexity, or their desire for simplicity. There's also added compliance costs, time to dedicate to actually design this custom plan for your family, which we recognize. But for clients with significant wealth, I'm still recommending staying on the path of estate design and putting the legal documents in place before the end of 2025, so that the structure is there before that deadline happens, in case it does in fact revert back to 2017 levels. And obviously, because there's a lot of uncertainty, we want to build as much flexibility into the documents as possible, so that we can pivot, as the laws change or stay the same. And some, like I mentioned, some may want to wait closer to the end of 2025 to actually pull the trigger and fund these structures, but at least they're ready to go at that time, and we won't miss out on windows of opportunity before they expire. And with that, I'll hand it over to Michelle to discuss other year-end considerations. And thank you, and we will be around for questions, hopefully at the end of this webinar, but if not, then we will get back to you after the webinar. Thank you. Michelle, I can't hear you. I don't know if others are having that problem.
Sorry about that. We'll start over. Continuing on, dovetailing off of what Charity said, we have a new Treasury Secretary nominee, Scott Bessent. There's not a lot of noise around his confirmation yet, so he is concerned about the size of the national debt. That is one of his things that he's particularly concerned about, and he has a broad economic plan. How that impacts taxes, which is our focus today, is he is prioritizing delivering on President Trump's election tax cut pledges, which are making the TCJA cuts permanent. However, he has caveated that with that will be matched with spending reductions, particularly looking at non-defense discretionary spending reductions there, revenue raisers elsewhere to offset the impact of making the TCJA tax cuts permanent. I think somewhat judicious use of tariffs where that may be appropriate. Restoring the state and local tax deduction, this would actually be a reversal of the TCJ, actually putting that back and eliminating the taxes on tips, Social Security benefits, and overtime pay. And eliminating the tax on tips is not that significant of a revenue adjustment, but the other ones are significantly more. So it may be maybe a little bit splitting hairs on that one and doing some or not all of what he has indicated he would like to do. So these are the individual TCJA expiring provisions. And before I jump into these, I did see a question about specifically bonus depreciation. Would that be brought back to 100% in 2025 or 2026? I think when you're looking at the TCJA expiring provisions, a lot of these have pretty broad support, and I would guess that the 100% bonus also has broad support. So elimination of the QBI deduction is significant. That impacts, millions of taxpayers who own small businesses, flow through businesses that are either wage heavy or fixed asset heavy. And so, that effectively makes the tax rate on that income from 37% down to about 28, 29%. So makes it more palatable to be a pass-through entity when compared to the C corporation rate of 28%. If that were to be eliminated, that'd be a significant higher tax rate on pass-through entities versus C corporations, which is something nobody wants to have. So that one has strong support for being extended, I believe, as well as eliminating the SALT cap would be huge. Although there are a lot of states that, I think 36 states have enacted the pass-through entity provisions to make the state and local taxes deductible at the business level. 26 of those states actually have permanent pass-through entity provisions. So regardless of what happens with the SALT cap, the PTE regime will still be available in those states. The ones that don't, looking at our footprint within Moss Adams, there are 4 states out of the 10, California, Colorado, Oregon, and Utah, which their PTE provisions will sunset if the SALT cap goes away. So we'll have to watch those states and see if they take any action to make those permanent. Standard deduction amounts, the larger standard deduction amounts has simplified the tax filings for a lot of a big population of taxpayers. That's likely to be retained, the higher amounts, and the marginal tax increases again to bring those back in line with TCJA also has a lot of support. So kind of a mixed bag here. I think there'll be, as Charity indicated, a push and pull with the desire to keep a lot of the TCJA provisions, but balancing that with revenue raisers and spending cuts elsewhere. Another thing in 2024, for those of you who have individual retirement accounts or qualified retirement plans, the Secure Act, which was enacted back in 2019, they finally issued some final regulations. Lots of things that were in the proposed regulations have been adopted in the final regulations. What the takeaways that come out of this are that for surviving spouses, there are a number of options. So if you have a situation where you've got an IRA and you're a surviving spouse, or you're advising someone who's a surviving spouse of someone who passed away with a retirement plan or an IRA, there are a number of options for surviving spouses to consider. They can, rather than just rolling it over to their own account, they can take it as an inherited IRA, have access to the funds sooner, or perhaps if their spouse was younger, they can get a longer deferral on taking RMDs. There are special rules should the surviving spouse pass away before they start taking distributions. So the takeaway here is that surviving spouses do have a number of favorable options if they choose to take the IRA as an inherited IRA rather than rolling over into their own IRAs. So if you're in this situation, you find yourself in this situation or working with someone in that, make sure you take a look at all the options before you just go ahead and default to a rollover for a surviving spouse. Roth IRAs and designated Roth accounts. Designated Roth accounts are the Roth portion of a qualified retirement plan. Under the Secure Act and the regulations, the Roth accounts and the Roth IRAs are very favorably treated. There are no required minimum distributions either during lifetime or in the period following death for individuals or beneficiaries of Roth IRAs or Roth accounts. So when you are looking at, does it make sense? Should I be funding my Roth? Should I be funding a regular IRA? Should I consider converting from a traditional IRA to a Roth? The benefits now of the long time frame for those assets to grow tax-free before you're required to withdraw them as the beneficiary of a decedent is significant. And if you haven't looked at that recently, probably need to take another look. One thing also is the Roth accounts only get the qualified treatment if they are separate, in a separate plan from the traditional account. So if your employer maintains both, you'll want to start paying attention to documentation that comes out about the options to they may be going to separate those plans. So just something to be mindful of, that the Roth benefits in a 401k, you only get those special no RMDs if it's a separate plan from the employers. Trust beneficiaries, they've also loosened up the rules on, made it more favorable if you're going to have a trust as a beneficiary of an IRA to be able to look through that trust to the ultimate beneficiary and have the RMDs based on that individual. There are decisions, and if the trust is not necessarily set up in the right way or doesn't have the right mix of beneficiaries, there are ways to actually cure that, as long as you act shortly after an individual passes away. So if you're in a situation, again, where you are assisting someone, or you have a situation with an IRA payable to a trust, take a look at that sooner rather than later. A lot of post-death planning can be done to make that more favorable, but you do need to act relatively quickly within a few months after passing in order to take advantage of those. A couple of significant Supreme Court cases to mention. One is Connolly versus the United States. For those of you who may be participants or owners of companies where there is buy-sell agreements in place and the company owns life insurance on the owners. A company owns life insurance on the owners, with the idea being that should one of the owners pass away under the agreement, the company will collect life insurance proceeds, use those proceeds to redeem shares from the estate of the deceased owner. The Connolly case was a situation of two brothers who owned a company together. They had a buy-sell agreement provided for valuation of the company. The company also had life insurance policies on both brothers. One of the brothers passed away. The company and the estate of the deceased brother, agreed on a price. They did not follow their own buy-sell agreement. They came up with the price on their own, used the proceeds to redeem the shares of the deceased brother into the estate. The estate tax return was filed. It was audited. The service disagreed with the value used to redeem the company, and also determined that the value of the company should include the value of the life insurance proceeds coming into the company as a result of the death of the owner. They also determined that the company could not take a deduction for the obligation to redeem those shares. And this case was challenged up through the appeals court and ended up being accepted by the Supreme Court because there was two different circuits with two different decisions on how to value the companies and how to treat life insurance proceeds coming into the company. And the Supreme Court agreed with both the district court and the circuit court that the value of the company did need to include the value of the life insurance proceeds and could not be reduced by the liability for redemption from the deceased owner. So the impact of this, of course, is to the estate. So the estate received proceeds, in this case it was $3 million, on the redemption of their from the company on the redemption of the stock. The service valued the company to the estate at significantly higher value than that. So the company or the estate had a significantly higher tax bill, but yet got no additional proceeds from the company. So their effective tax rate on the company was significant, well over the normal estate tax rate. So the estate was the one who ultimately ended up being harmed by this. And so the couple issues coming out of this, one is to revisit, for those of you who are owners of companies and have buy-sell agreements that may provide for redemption, take a look at whether that is still a method you want to use, or whether you would rather have what's called a cross purchase, where the other owners purchase stock of the deceased owner rather than the company, how you want to have life insurance on the owners held, if you want it to be held by the company, or whether by other owners. I know that can get unwieldy if you have a lot of owners, but at a minimum, making sure that your valuation provisions for the buyout reflect the value of the company, that if you do decide a redemption is the way to go, that the amount that the estate will get paid includes the value of the proceeds, so that they're getting an appropriate amount compared to what the valuation will be, so that they're not getting harmed by a difference in value compared to the tax that they have to pay. So that was the Connolly decision, and that is reverberating out through the legal world and the business world right now. So take a look at those agreements. The other one is Loper Bright Enterprises. This was a situation of a group of commercial fishermen that sued against the National Marine Fisheries Service, where the Supreme Court ultimately ended up hearing the case and determined that under the Administrative Procedures Act, the court has to reasonably evaluate the merits of the case and cannot rely on the interpretation of the laws by the agency that wrote the regulations. And so this is a departure from the long-held Chevron doctrine that gave sort of undue or a lot of weight to an agency's interpretation of the rules. And so this will impact tax law. There's a lot of tax regulations that are written by the Internal Revenue Service that are interpretive regulations. They're intentionally designed to interpret what the Internal Revenue Code says. This does open up a lot of Treasury regulations to potential challenge now and a revisit by the court. So we may see a little more court cases, a little more challenge to regulations and IRS rulings that we have not seen in the past. Okay, last little bit here, Internal Revenue Service update. So we talked about the Treasury Secretary nomination. The current commissioner of the Internal Revenue Service is Danny Werfel. Interestingly, the commissioners are appointed to a 5-year term. That is by design. They are intended to cross over political elections. So this current term runs from November 22nd to November 2027. Mr. Werfel has indicated that he intends to stay in his position until November 2027. However, that is significantly far into President Trump and this Congress's term. So it may be a situation where he may be asked to leave prior to his term being up. He does have just a little cat slide here for cat picture for everybody. Emmett is his cat, quite the Instagram star if you follow the IRS Instagram page. But what's happening with the IRS, and if any of you have been waiting for refunds or have notices from the IRS that you can't seem to get resolved, you're not alone. Almost all taxpayers are finding this. We are finding this with all of our clients. And what we're watching of interest is the $80 billion that the IRS budget was increased by under the Inflation Reduction Act. They got $80 billion over 10 years. And this was originally on this slide here, how it was to be distributed out. And the two items that are circled there, the smaller amounts, were business systems modernization and taxpayer services. These are both desperately needed by the IRS. Their systems are antiquated. They don't talk to each other. Taxpayer services, while I think the IRS has done a good job in the last couple of years of slowly digging itself out from its COVID backlog, a lot of their employees and a lot of the individuals you'll talk to if you call the IRS are new within the last year or two of newly hired to the IRS. So they just don't have that weight of experience that all that the old employees of the IRS used to have. So it's an uphill battle for them, and hoping that, as they move forward, if they're, it's one thing you kind of want to root for funding, maybe perhaps in the enforcement of the IRS, the enforcement arm, but certainly they need the funds when it comes to the modernization of taxpayer services, and we definitely hope they make some progress there in 2025. So with that, I will turn it over to Dominic.
Thanks, Michelle. So let's start off with some current market trends that we're seeing. So we still have, a longer, intermediate, and shorter term bullish trends intact in the market. And we're heading into what is historically a strong seasonal period. So earlier this year, we had quite a bit of narrowing again in market leaders, kind of reverting back to the Magnificent Seven and even the Magnificent Five at times, which led to a lot of market concentration at the higher end of the market cap spectrum. But we started to see that broaden out, and a considerable amount of market breadth, which we want to see and what is healthy for the market, has expanded, especially post-election. So we've kind of had an everything rally post-November, the first week in November. Along with that, we've seen animal spirits return. So sentiment has been rising both from investors and consumers, but most importantly, capital markets. And that's due to a potential for deal making. There's discussions around M&A. It's increasing everywhere. So we see banks are preparing teams and clients for opportunities in the coming year, hopes for better multiples, lower interest rates helping, and potential for less regulation, which is all driving essentially the excitement for deals coming back to the market, whether that's in private capital markets, IPOs, what have you. The Fed. So as we all know, the Fed began a cutting path in September with a 50 basis point cut. They added another 25 basis point cut prior to the election. And now they're adding another 25, most likely in December. Yet to be seen what 2025 will look like given the new administration. So still on a rate cut cycle, even with the potential for stimulus from the new administration, not direct fiscal stimulus, but different growth policies. That some have fears of rising, new rising inflation and considerable growth that could bring us back into what might need to be cuts, or what might need to be increases in the federal markets rate. So with 2025 yet to be seen, we've seen the 10-year start to rise actually as the Fed has cut rates. And a lot of that largely could be driven by three different reasons. Inflation fears, as I mentioned, that the Fed might have to either pause or reverse course with their cutting policy. Signs of expected increases in growth. But what I think is most likely is an unwinding of a fear or recessionary trade where you have a lot of investors moving away from safe haven assets like treasuries because there was a fear of recessionary or slowing growth concerns and are kind of joining the FOMO train. And entering more risk-based assets. Some might say it's probably a combination of both or all three, which is probably most likely. Then finally, market has really enjoyed the potential Treasury and rumors of future Fed picks, since Jerome Powell still has a number of years to serve. But comments around his respect for precedents now that the election is over, yet to be seen if he will hold that respect. I know we'll most likely get comments around how the Fed is doing while Powell is still serving, and even whoever ends up being his predecessor. But there has been some credence to tradition in that regard. We've also seen a domestic focus, both with the dollar strengthening. There's been a focus on U.S.-centric policies with the new administration. Higher yields, as I mentioned above, also add to the dollar strengthening. Fewer trade partners abroad or more onerous trade relationships, with tariffs possibly coming back, whether that's used and actually implemented or primarily used as a bargaining chip. Either way, domestic markets are being seen as much more of a center for investors as opposed to both developed and emerging markets abroad. So with that, you also see in tandem, of course, foreign currencies weakening and U.S. markets seeing outsized investor flows, both from domestic investors and international investors. Then finally, I know it's misspelled there, but talking about the Santa Claus rally as we get into the end of the year, on average, we see a 1.5% to 2% rise or return in the market during that period, which lasts into January, with positive years like we've had and robust rallies like we've had this year so far. It only statistically is likely that trend will continue this year. We're typically positive during that Santa Claus rally 80% of the time. If we look at rally years like this year, that percentage only increases above 90. So now that we kind of know where we're at in the market, a few year-end considerations from an investment and tax perspective. So tax loss harvesting, always remember that if we're looking to either offset realized gains or banking losses for the future use, looking to harvest those losses in your portfolio in taxable holdings, maintaining a similar position or rebalancing to something else during that wash sale period or moving forward. Another year-end consideration in regards to tax loss harvesting would be don't be chasing other investors' losers. So if you're actively trading or trading individual positions in the market, this is the time of year where active traders, institutional traders, and portfolio managers are ditching a lot of their users, not only for the same reason, to bank losses and capture losses to offset gains, but they're also window dressing portfolios or repositioning losing trends and just selling altogether, as opposed to doing any kind of tax loss harvesting where they'll move back in. So seeing a stock down a considerable amount is not usually a buying opportunity, but especially in the bull market that we've had this year, it certainly is not a trend you'd want to follow. Taking stock of capital gains distributions and the efficiency of those holdings. So those with mutual funds receiving capital gains distributions near the end of this month. If they're in taxable accounts, this is an opportunity to figure out if those funds really are as efficient for your strategy or your plan. It can be an annual taxable surprise when you are more likely to stay invested or have a long-term strategy. So seeing if those funds actually align with your strategy and your potential need for those funds, it's a good opportunity since this only comes around usually once a year. Finally, benchmarking performance and rebalancing. The calendar really is kind of an ambiguous time frame in investing, but it is a good reminder to measure performance against if you have a benchmark in mind or some sort of model that you deem appropriate for your risk. Is your strategy really working? And of course, whether it is or not, rebalancing and not letting outperformance lead to excess risks. So, cutting down some of your winners and allocating to other areas of your portfolio that may not have done so well. All right, then looking forward a little bit with some of the policies, which kind of reverberate through some of the commentary that both Charity and Michelle had with the new administration. So a few reminders: don't get ahead of actual policy. There's a lot of things that are yet to be seen with the new administration and the potential for new policies. So trying to invest ahead of any actual policy coming to fruition Whether we understand the full effects, the formation of that, or even just the ability to pass some of these policies still lacks a ton of clarity. And we would rather be late and informed than early and completely wrong, especially with the ever-changing nature of this administration, since we've already had the opportunity to experience 4 years of this, where we know there's a bit more volatility in decision-making. Tech and infrastructure spending tailwinds are some of the largest we've seen in the market in history, both in the public and private sector. So right now, we still have $1 trillion in government spending that's earmarked for infrastructure projects, both half of that being new projects and half of that being repairs or upkeep of the existing projects, and that is yet to be spent. There's also $1 trillion earmarked this year by private companies for infrastructure spending as well. Looking forward, there's an estimate anywhere between $30 to $75 trillion needs to be spent on infrastructure over the next decade or two, just to upkeep and improve in order to maintain infrastructure that we need and that's in existence. That is a considerable amount of capital going into the market in a very specific asset class. So that's why infrastructure projects and infrastructure adjacent companies have quite a bit of a tailwind here going forward with those growth potential. AI is everywhere, as I'm sure most of us know and most of us hear about. So obviously an opportunity with the capital spending. I would not be necessarily looking at who's going to win an AI race, but what companies are benefiting from the AI race itself, similar to infrastructure, more AI adjacent spending, whether that's data centers, the utilities that support data centers, the energy and infrastructure needs for semiconductors, anything that's participating in the AI race obviously has opportunity instead of trying to pick the AI winner in any specific type of company. Cybersecurity. Still think we're in the early innings of this. It's a very new and niche sector of the market, but there's a considerable amount of insurance concerns for pretty much any company, not just tech companies, and how these hacks continue to increase in size and frequency. So companies aren't necessarily insurable at this point. So their only opportunity is to put cybersecurity in place. I know I get emails all the time about my data having been leaked, and it seems like it's only becoming more frequent and common, and larger and more brand name companies that I'm receiving those emails from. So in order to jump in front of that, cybersecurity is really what companies have to engage with at all sizes. Infrastructure, as I mentioned above, so I won't repeat that again. And then utilities. As rates fall, utilities benefit as a bond proxy. There's also relative return to stock, considering combination of both yield and growth. They benefit from the tech spend and the AI spend, as I mentioned. And if you have any concerns about a recession or the market possibly pivoting, utilities are somewhat of a risk-off play if you still want a equity-like return that may not be as growthy as tech or AI. Cash complacency, really good opportunity right now to consider cash and interest rates in the market. Money markets continue to fall, and that's because the Fed controls short-term rates. So we're seeing this impact in real time since long-term rates have started to rise. And as I mentioned, long-term rates are rising because there's more considerations for potential growth from the new administration coming in January, or potential for inflation. But money markets are falling, so investors have an opportunity for these longer rates and their ability to lock them in and get out of cash or shorter term instruments if they have some complacency in their cash that should be part of their investment portfolio and is not earmarked for any sort of short-term need. Also, bonds really aren't crash insurance like they were for the prior decade, where there was essentially zero interest rates and they were just a ballast. Right now, they're more of a traditional risk-adjusted return to stocks. They're offering you an opportunity if you don't want to participate in the equity markets or want a more balanced approach. And then finally, privates and alternatives. Private investments and alternatives are becoming more popular than ever due to democratization of the platforms and accessibility for investors. So the two asset classes that we really like right now and are interested in, again, would be infrastructure and real estate. Went through the infrastructure story a little bit above. In this instance, though, with private investments, you're owning actual infrastructure assets as opposed to the adjacent companies that are helping with the infrastructure projects. These assets typically have monopolistic type contracts, heavily predictable cash flows. They're also inflation protected. If we continue to have high inflation or even maintain what used to just be normal inflationary levels. Then real estate, kind of a wave of caution the past year and a half in this market with rising interest rates, was really kind of pigeonholed to the office place in metropolitan areas for the most part. But we have seen a lot of repricing in a lot of different real estate areas. So if you're looking for opportunities in real estate, looking for a good manager that relegates those risks to other areas like industrial, multifamily, healthcare oriented properties, and understanding, population trends, essentially looking at what's going on in the Southwest, aging populations and the need for more healthcare type facilities. So those would be opportunities if you're looking for, real estate exposure to look at in the private space. So with that, I think we have some time for questions.
I see one question here. Looks like Paula asked, is BOIR required since Texas ruling this week? What that's referring to is Beneficial Ownership Information Report, BOIR, that is part of the Corporate Transparency Act. And it appears that the answer is we don't really know. I mean, right now there's a national injunction that has been issued by a Texas court stating that, it's unconstitutional. The expectation is that this will be appealed and could be resolved as quickly as by the end of the year. That was supposed to go into effect January 1 of next year. So we really don't know. I mean, the ruling just came out, was it yesterday or the day before? But as of right now, it is state, there's an injunction in place, a nationwide injunction, which is, these are pretty rare. The judges issue those. That's outstanding. So more to be seen with that.
Yeah, I would say add to that, if you haven't done your reporting yet, it is due, barring any changes, it is due by January 1st or before January 1st. And the penalties are pretty substantial, over $500 a day for willful noncompliance. So I would say, be prepared to file on short notice if the injunction is lifted or anything changes. And of course, this is a legal, we defer to legal counsel on these. So if you have an attorney assisting you or a law firm assisting you, I would definitely, do what they advise you to do. But yeah, I would say be prepared to file it. I know the FinCEN has not issued anything yet on, they're still accepting them and they have not agreed to honor the injunction as of yet. Are there any other questions? Otherwise, I think that's it.
Well, thank you everyone for attending.
Awesome. Thank you, Michelle, Charity, and Dominic for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.